talking about a very important element of the financial markets, and that is understanding price charts. Because the whole entire field of technical analysis is all based on prices and on charts. Some people refer to it as charting or chartists. It's no secret that online trading can be perform more efficiently if you possess the necessary tools. And a good place to start is with charts. Now, we have fundamental, technical, and quantitative analysis. Now, there are a number of methods used by Forex and CFD traders to predict the movement of currency pairs or other assets. Some traders focus on news, interest rates, and economic variables, while others prefer to use charting tools and indicators to guide their decision making. However, no matter your trading method, you'll need to know how to read a chart. There's no escaping it. Luckily, we created this detailed webinar to help you get started. Now, you need to crawl before you can walk. And charting is no different. You first need to have a good understanding of the basics before you progress. And that's why we have 3 classes back to back. We have tonight's class, next Tuesday, and next Wednesday. So tonight we're going to look at charts. Next Tuesday, we're going to put the first important lines on charts, which are, we're going to learn about trends and trend lines. And then on Wednesday, we're going to learn about support and resistance and volume. Now, regardless of how you want to trade, regardless of what you say you want to trade, you want to look at earnings reports, or you want to trade when Steve Jobs tells you, or Warren Buffett says something, that's fine. Okay? You can use all that to make your trading decision. But there's nothing in that arena that's going to help you decide exactly what price to enter the markets, where to put your stop loss, where to make your take profit point, and how to monitor the progress of your trade. That all happens on a chart. And this is why a price chart is so important. Now, a price chart is simply a graphical depiction of the current and historical price of an asset. Now, charts usually have several different display modes for displaying price. One method is called Japanese candlesticks, and today it's one of the most popular methods. Not necessarily the best, but the most popular. Because of computerized charts, we're able to use these candlesticks and put candlesticks easily on the charts. The most used up until we had this online trading revolution were bar charts, and they're my preferable type of trading. But price can be displayed as a line. And so the basics of a chart is you have a line chart, a bar chart, and a candlestick chart. A bar chart will show you where the price opened, the high, the low, and where the price closed. And so will the candlestick chart. A line chart is what you're looking at on your screen. On the other hand, simply connects the closes of each time frame and connects them with a line. So you're just connecting dot to dot to dot. It gives you some general information. Now, it does take the noise out of the markets. It's not really good for analysis purposes, but it's good to show you an overall trend or where the asset you're looking at is moving. So a simple line chart draws a line from one closing price to the next. When strung together with a line, we can see the general price movement of a currency pair and asset over a period of time. Now, as I said, my favorite is the bar chart. And in this case, instead of a dot at the close of each period, we put 4 pieces of information on each one of these bars. So whether you're looking at a 30-minute chart or 1-hour chart or 1-day chart, whatever the time frame you're looking at, this chart depicts the open of that period, the close of that period, the high reached in that period, and the low. So if you're looking at a 1-day chart, it's the beginning of the day, the end of the day, the highest point it reached during the day, and the lowest point. If you're looking at a 1-hour chart, it's the open at that beginning of the hour, it's the close at the end of the hour, it's the highest it reached in that hour period, and the lowest it reached in that hour period. And they're connected by a line. And they give you a very nice visual representation of price movement. So we have the open, the high, the low, and the close. So each bar is relatively simple. You draw a dash across at the open, a dash across at the close. You put a dot at the highest point of each in that period and a dot at the lowest point and just draw a bar. Now, if you step up the ladder from the open to the close, this is considered a bullish time frame. If you step down the ladder from the open to the close, this is considered a bearish time frame. Okay. So you're seeing in this one little line, 4 vital pieces of information, plus getting a story about how the market sentiment is at the moment. A candlestick is very similar to a bar chart. It gives you, or it's based on the open, the high, the low, and the close. And it gives you the bullish and the bearish sentiment of that period. Okay. Now, each candlestick, instead of just drawing a bar across, at the open we draw a line across. At the close we draw a line across. We put a dot at the highest point, a dot at the lowest point, and connect those to the lines. So we have the high, the open, the low, and the close. So for both the bar and the candlestick chart, we have what's called OHLC, open, high, low, and close. The difference with a candlestick is if we stepped up from the open to the close, that is just like a bar. It's a bullish period, but in this case, we would color the candle in white or green. In the old days, it was white because you just didn't color it in because you were hand charting. Today, the computers, we use green, but that's just a preference. You can use pink and orange. You can use violet and gold, as long as you know which one denotes a bullish candle and which one denotes a bearish candle. Now, the biggest drawback to candlesticks is that when we color the candles in with reds and greens, we have a psychological effect because we're human beings, and human emotion and human psychology plays a serious part in the markets. Now, the reds and the greens are, especially by novices or by even experienced traders who are not reading candlesticks but using a candlestick chart, see lots of green and think negative or bearish, and see lots of greens and think bullish. But the fact is, that's got nothing really to do with candlesticks. Candlestick charting is different than bar charting because it has to do with the shape and the size of what's called the body of the candle and the wicks. So as you can see on this chart, we have long-bodied candles, we have short-bodied candles, we have candles with almost no bodies, we have candles with long lower wicks, and candles with long upper wicks. And candlesticks are all about the placement against the preceding candle and the next candle, as well as the shape of the size of the body. And this is why we have actually in 2 weeks from now, we have a whole class on candlesticks. But candlesticks have 32 basic patterns. And these patterns have to be interpreted. We have Harami, we have Doji, we have Marubozu candles, we have bearish engulfing and bullish engulfing. So what happens is too many traders get involved with the reds and the greens and don't know how to properly use the candlestick charts. So they're a great charting system if you just want to look at it and don't want to let yourself get involved in the reds and greens, or it's a great charting system, a great charts if you learn the basics of candlesticks. But these are the 3 general types of charts. Now, from these charts, there's many variations, okay? And today with computer charts, there's more variations than I care to ever know. I mean, they just go on and on and on. And today's charts allow us to move from one to the next easily. So even though I say bar charts are my favorite, I do use candlesticks. But today, because of, like I said, because of computerized charts, we can easily move from one candlestick or one application to the next very easily. So as you can see on your screen, we are looking at a standard. This is just TradingView charts, or you can look at the charts right on the ETX platform, whichever is easiest for you. They're all the same. All the charts will give you the same information. There is no unique information from chart to chart because price is price. And each one of these candles or each one of these bars denotes a period of time and the actual prices that happen. Now, we are currently looking at the Euro US dollar 1 hour chart. Now, what that tells us is that every 1 hour, one of these bars is finished on the chart. So we would have the low, the high, the open, and the close for that 1 hour period. Now, by using multiple time frames, because if we were going to look at this in a 1 day chart, we would then be seeing 24 of these lines incorporated into one line. Okay, so the smaller the time frame, the more breaks you get, or the more actual views you see of each line of the chart, each time frame. Okay, the price doesn't change. So if we said that the Euro US dollar went from 115 to 118 over the last hour, that doesn't ever change. But it happens to be that if we broke it into half-hour segments, that Euro US dollar might have gone from 115 to only 116 in the first half hour, and the second half hour moved from 116 all the way up to 118. Or it could have gone from 115 in the first half hour to 118, and then the next half hour ended up at 116. It still had that same range, but we're getting more specifics. So a lot of the use of the charts is being able to see multiple time frames and adjusting time frames to your trading strategies. Now, as you can see here, we're looking at, like I said, the 1 hour chart for the Euro US dollar. We're looking at the bar chart. So we want to change it today to candlesticks. We just simply click on candlesticks and we have the same charting. We don't have to change our analysis. We don't have to change lines or trend lines. Everything will be transferred over. And then if we want to go back, we can go back. So we have many advantages to today's chart. And same thing on the ETX platform. If you're using the ETX charts from the MT4 or on the web-based platform, same thing. You can just flip on the correct buttons. Now, one of the reasons we might want to look at multiple time frames is right now, like I said, we're looking at the Euro US dollar. And if we look back to here, now this is taking us back to May 30th right here. We can see the Euro US dollar has been what? In a steady uptrend, steadily moving up. So you're getting an impression of the Euro US dollar. But if we were to go back and look at that in a 30-minute time frame, we might see that the Euro US dollar was more or less congested over the short term and then has taken a very big leap forward today. I mean, look at this rise in the Euro US dollar. So right now we have a very strong short-term uptrend that is also part of a longer-term uptrend. Now, if we were to go back and look at it in a 1 day chart, we might see something completely different. What's happening with the euro? Well, the euro is actually in a hardcore downtrend going back until April. We can almost see it going back, here it went into congestion, but here, starting here, look at that downtrend. That tells us something about the euro. Because when we were looking at it in a half hour, we saw it was moving in a very short-term uptrend, very positive. We looked at it in 1 hour, again, very positive. Okay. When we look at it in a longer-term frame, we're now more understanding the euro is really in a recovery from a long-term downtrend. So these different time frames that the charts give us the ability to look at help us get a better understanding of an asset so that we can define its movement more precisely. Because knowing that you're in a longer term downtrend, so the euro's trading near the bottom of its the prices for say the last year, and it's moving up a little, is a lot different than saying the euro's trending up. Okay. So it gives you a better understanding of how price is moving. So let's go back to my PowerPoint for a minute here. So one of the best reasons to learn how to read a chart correctly is so that you can apply technical analysis. Now, not every trader believes in using technical analysis, but it can be useful even if it's not your primary method of trading. Technical analysis relies on the price that is on the chart you're using. So a general explanation of technical analysis is anything that's done on a chart. We were just conducting, by looking at those charts, technical analysis. Sometimes it just is referred to as charting. Now, technical analysis incorporates a huge amount of information ranging everywhere from indicators and oscillators to chart patterns and trend patterns to all types of other types of things that we conduct on a chart. But anything that we conduct on a chart, or anytime we look at even a simple line chart, we are in the field of technical analysis. Now, technical analysis relies on the price that is on the chart you're using. Most charting systems will allow you to add technical analysis tools as overlays on your charts. Now, as always, check the time frames displayed. Many trading systems will use multiple time frames to determine an entry of a trade. For example, a system may use a 4-hour and a 30-minute chart to determine the overall trend of a currency pair by using indicators such as MACD, momentum indicators, or support and resistance lines, and then may use a 5-minute chart to look for a rise from a temporary dip to determine an actual entry. Because only a chart and only technical analysis will give you actual prices. Like I said, if you're looking at news or headlines, you're looking at an OPEC report or an oil inventory report, or you're listening to a Federal Reserve decision or a UK central bank decision or an inflation report from the UK central bank, that might tell you that the euros or the pound or the dollar should rise, but it's not going to tell you what price is going to rise to, what price it's rising from, or where to enter the markets. You need to do this with analysis conducted on your charts. So to ensure that the chart you're looking at has the correct time frame for your analysis, the best way to do this is set your charts with the correct time frames and indicators on them for the system you're trading and to save and reuse that layout. And today, if you're on ETX, once you set up your charts the way you like them with the indicators, you just click on Save button. Save the template and it'll always open up the same. You're using a different charting service, again. Now realize that the time shown on the bottom of the chart are set to the particular time zone that the charts are being provided. So on ETX or any of the charting services, we can do a setup. And one of the most important things you can do when you're looking at your charts is look for the format buttons. You can do lots of things with your charts. Okay. The most important thing that you want to do is set up your time zone, because all of these clicks and all of these lines, and when you go back, are all going to be given to you in the time zone that you have selected there. So if you're sitting in London and you're on BST time and you have your chart set to UTC time, guess what? You're seeing figures that are the wrong hour. If you're in, the US and you're looking at charts, or you leave it left set at US time, you're seeing the wrong information on the bottom of your charts. Now your charts will tell you at the bottom what time zone you're looking at, but you want to make sure you got them set up to your home time zone. It just keeps you out of trouble. Because you also want to know when trading sessions are over and markets are open and markets are closed. Now, granted, when we're trading cryptocurrency or we're trading Forex, they're 24 hours a day. But if you're trading a stock, you want to see whether it's an open or closed market. If you're trading oil or gold, you want to know if it's currently trading or the markets are closed. So you can put lines in your charts that'll give you session breaks and time breaks. You can see extended hours of trading on your charts. You can set up the color coding of the charts, the theme of your charts. Okay. You can set up your background and the colors you like and the values you want to have on your charts. And you only have to do this once because it'll save it. Whether you're doing on ETX or TradingView here, it will save everything. And that way you get charts quickly and easily that you're used to looking at, because when you see them the same all the time and you're not seeing different people's charts and different things, you won't get confused and you'll start to be able to make sense of what's happening on there. Okay. You can choose your own styles. Like if you want to change, like I told you, if you want to make your candlesticks pink and orange, you can use them pink and orange as long as you know which ones are bullish and bearish. You can decide whether you want to see your wicks. You can decide on your bar charts. You can actually set your bar charts to actually give you color. You can have a red and a green up color and down color on your bar charts. So you can decide what you want to see. Okay. So charts are more than just looking at a price chart. It's setting them up and getting them ready for you so that you can properly trade. You can see your positions, your open positions. You can see your stop losses on chart. Everything with ETX, every trade and everything that you have going on the platform, you can then store and see on your chart. So when you look at the euro US dollar, you have an open position, you can see right on the charts the stop loss you've set. You can see the take profit. You can see where you entered the trade. There's many things you can see on the charts if you set them up correctly. Now, once you have things like the asset you want to look at, you have the time frame you want to look at, you have the style of chart you want to look at. Okay, you're moving there. You can start making sense out of what you're looking at, because we want to be able to put things like trend lines on our charts. You can see I've got my previous trend lines on here from other classes. You can also then start putting what we call indicators, which are technical analysis indicators right on your chart. So you can then drop Bollinger Bands. You don't ever have to do the calculation. You put RSI, MACD, momentum right on your charts, because there's indicators that go below your price charts and you look at them in conjunction with your price chart, and other indicators that are put right on to your charts. And you can then start making trading decisions or using them to analyze how the markets are moving. But you can't use these indicators if you don't have your chart set up correctly. Now, as we can see here, we have this chart that's set up already with candlesticks, and we've added on an indicator called Fibonacci levels, which give us support and resistance levels. Now, this chart, we haven't had any trend lines on, but we have stochastics down below, and we're looking to decipher something that's happening in the markets with price movement by using our support from our Fibonacci levels. Now, we're not going to be here to learn about fibs tonight. We have a different class for that. But these are the reasons we want to use charts. Okay, here we have a very simple chart, which has got a moving average line and a trend line on the candlesticks to try to predict price movement. Now you see here, the euro US dollar just completed a 4-hour pullback and reached above the 89 EMA, which is the exponential moving average. And we also got a pin bar, which is an engulfing candle formed from the candlesticks. Now the trend line has also been broken. Therefore, we would sell the euro US dollar at 117.30 and aim for a drop to 116 and to 115.50. Now, say to me, that's kind of ridiculous. We see it in an uptrend. But remember, when we looked at it in other charts, we actually saw it was the bottom of a longer term downtrend, and it's simply a retracement. And if you understand how markets move, when we talk about trends and trend lines, you'll understand that markets go down, they retrace, and they continue back down again. Okay, so we're just actually on one of the legs, but you have to understand and be able to see this on a chart. I just want to clean up my screen here for you guys. Okay, and then one of the other reasons we want to learn to read charts is so that we can apply or look for what's called chart patterns. So let me get some of the stuff off this chart so we can see it a little bit cleaner. So what we're looking for and what we just saw in the price chart right here is a triangle formation. A triangle formation is part of what we call chart patterns. We have ascending triangles, descending triangles, symmetrical triangles. But we can track price as it moves into the center of this triangle. We can combine that with volume, and because eventually as the price moves into the apex of this triangle, at some point, we don't know whether it's going to break out. We know it's going to break out. We don't know if it's going to break up or break down, but we can actually calculate the momentum of the breakouts. And when we see a break in one direction or another from this pent-up momentum here, we can actually decide to trade it and figure out where our profit level should be and use the triangle to determine how far that momentum should carry us and where to put our stop loss. Okay, so we look for these patterns. We look for triangles, we look for wedges, we look for what's called flags or pennants. We even look for something called head and shoulders or teacups. These are patterns that traders tend to repeat over and over in historical trading. Because they are so well established, we can then interpret them and apply these to our trading. Because these patterns, when they exist, are telling us something about the psychology of the markets. But you can't see these without using charts. And without looking at your charts, you can't make any real intelligent decision or track price. Again, Walmart comes out and announces they're going to open up 1,000 more stores and that their online trading is soared, 400%. Yeah, their stock is going to fly. But at what point? Did the markets anticipate this and has already moved up and it's too late for you to get in the market? Or did the market get surprised and did the stock soar? Sure, when you're reading the headlines of Wall Street Journal or MarketWatch tell you that Walmart went up 22%, it's too late for you to get in the markets. You need to get in the market when that Walmart starts to move. Well, that Walmart stock is most likely going to start to move as soon as that announcement hits, not when you see it in the headlines. Okay? If you were looking at your charts and using technical analysis, you could see when that price was starting to rally. You could decide when to enter that market, where to exit that market, and where to put your stop losses. And you're only going to get this from your price charts. So let's go back to my PowerPoint again, and let's see what else we can learn about charts tonight. Okay, so one of the most important steps in using currency charts or any other charts is to set the specific time frame. The values that you view are only relevant to the specific time frames that you want to establish for them. Charts help traders evaluate market behavior and help them determine where the security will be in the future. To help make sense of the price movement depicted on a price chart, traders have developed a number of different visual guides to assist them. Indicators. Now, there are hundreds of different types of trading indicators developed to cover every aspect of trading from trend following to means reversion. And that's a whole different ball of wax out there. Okay. Once you learn to use charts, you can decide what indicators and what oscillators you might want to add. But these become part of your trading system. So once you've decided what charts work best for you and what time frames you want to use, then start adding some basic information to your charts. Now remember, any analysis done on a chart is considered technical analysis. Now, I believe, regardless of how you want to trade, what information you want to use, and how much you want to learn, regardless of your strategy, you need to put some basic lines on a chart that will help you understand the markets. And the first line that anybody should put on a chart is a trend line. And that's next Tuesday's class. So we're going to spend an hour understanding not just trends, because there's a difference between trends and trend line. Trends is the general movement of the market. And the markets can only move in three directions: uptrending, downtrending, or sideways trending. We need to be able to see these, but then we need to be able to apply a trend line. Now, trend line is a rule-based piece of information that helps you, because that trend line you draw will be the same trend line that the guy 1,000 miles away from you is drawing. So that gives you a firm, hardcore piece of information that you know somebody else is looking at to evaluate the markets also. Then from there, you can start customizing your trading strategies. But if you get something that you know everybody's looking at, you can start making some sense of the markets. So a trend, though, also has information. There are weak trends or strong trends. Trends don't move because too many people think price in an uptrend moves like that. If you see a line moving like that, you got a problem, and it's not a good market to trade. A trend line will move, or a trend will move, push and ease, peaks and valleys. And a well-developed trend line will have these peaks and valleys. And you need to learn how to interpret that so you don't panic when it's going into that slight valley. Because you want to, if you enter a trade here, you want to be able to maximize and stay into the markets here. You don't want to panic every time it goes into those valleys, because a well-developed trend has to have those peaks and valleys. Okay. So you want to be able to see this on your chart, but you also want to start adding some information and rules and guidelines to it. Now, every trader should be able to add some basic building blocks: trend lines, support and resistance lines, and volume. So after we have our trend line class on Tuesday, we have a class on Wednesday next week on support and resistance and volume. And at that point, you should be able to understand what you're looking at a chart, and then start incorporating it into your decision making, and then decide whether you want to look at price patterns or you want to be an indicator trader, or if you just want to use technical fundamental analysis, but use technical analysis to tell you where to exit and enter a trade. Okay. But we'll talk about that as we move into what is technical analysis. And then we have our classes on MACD, our class on Fibonacci, we have a class for you on RSI, we have a class on stochastics. All of that to try to explain to you, but all of this sums part of your understanding of charts. Now, my advice to you, because today we don't chart by hand, and when I learned to trade 40 years ago, the first thing that I was taught by a broker was pick an asset, and we were hand charting. So you got to understand and feel that asset and understand the personality of that asset. Today we don't do that, so we're a little bit removed. But what I would say to you is take an asset, any asset, not an asset you want to trade. Take something that's of interest to you. You know, if you're going on vacation to Australia next year, take the Aussie dollar. Okay. If you like Apple, take Apple. If you like Google, take, and start looking at that chart 2 or 3 times a day. Look at it in different time frames. And as we go through class, add the trend lines, add the support and resistance, we'll add the volume, and keep looking at that single chart and get yourself as familiar as possible. When you feel comfortable with your charts, you'll then be able to translate that into all the other assets. So just take one asset, because you'll start being able to see how news and headlines and economic events actually affected that asset. You'll actually be able to see when the Australian jobs report came out, right on your chart, you'll be able to say, well, I can tell whether it was a good report or a bad report, because I can see how the chart reacted. And when you start to see these correlations and start to develop and understand how to see a personality of an asset, You then get to understand and trade that asset because you understand it and know it. And this is the comfort level that you should have. So like I said, anybody take whatever asset you want. If you want to take oil, you want to take gold, you want to take Bitcoin, you want to take one of these new coins that are coming out, whatever you can get on a chart on, take it. Just start play. Don't trade it. We're not talking about making trading decisions. Start looking at the chart regularly. Start looking at the indicators regularly. Start, like I said, next week we'll put on the trend line. Start, flipping it between bar charts and candlestick charts. Look at it in multiple time frames. Start to familiarize yourself with it, and then build. Use it as we build along in each class. So on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. And remember, you can see a recorded version of this class using the same link that you came tonight. And we'll see you next Tuesday, and we'll start looking at trends and trend lines on your charts. Have a good evening now, and thanks for supporting ETX. Good night now.